Another Burger King franchisee has filed for bankruptcy. Welcome to the Week in Restaurants, a weekly look at some of the most important news in the restaurant industry. I'm Jonathan Mays, editor-in-chief of Restaurant Business, and I'm here this week with RB executive editor Lisa Jennings. This week, we will talk about the latest bankruptcy of a Burger King franchisee. We will also give our thoughts on the Technomic Top 500 Chain Restaurant Report, which provided some unique insight into the state of the overall restaurant industry. And we have some takeaways from the recently concluded Restaurant Leadership Conference. Later on, Joe Guszkowski dishes on the state of industry technology, and we also bring him on to talk about his interesting story on the Hooters debacle. But first, Lisa, I hear you were in Phoenix for the Restaurant Leadership Conference.
Yes, I was, and you should have been there. Oh, wait, you were there. You were everywhere there.
Yeah, they make me go places.
Yes.
So they made me go on stage all the time. I can't believe they did that to me.
It was actually,
it was fun. It was good. It was a really good conference, actually. I should not mock RLC. RLC was wonderful this year. I was very happy. What did you think?
I thought it was great. I mean, I have to say it was an interesting mix of optimism and fear. I mean, it was really kind of crazy how people were talking about what was going on now. But I love that Chili's had such a great moment. Kevin Hochman was a rock star, and that was just such an interesting part of all of it. And I heard conversations from just talking to people in the hallways. Everyone seemed really pretty happy and optimistic, and there's a real feeling of we did it before and we can do it again. I mean, there was kind of a sense of we've been through something worse, so we can handle this, which is nice.
Yeah, that's a really good point. I think in many respects, it's almost kind of indicative of just the overall state of everything. Because I think, right, if you look at economic data right now, just take a look at the overall state of the economy and you just ignore the market. You ignore the stock market or the bond market or social media, because you can't. You'd have to ignore social media or television or the newspaper or the radio, whatever. So you got all that. All you're just looking at is pure economic data. And gosh, inflation is trending downward. Unemployment remains low. I believe the Futurists noted, for instance, at RLC that the percentage, the workforce of the teenage workforce is higher than it's been since the Great Recession, which is actually interesting. Teenagers are a pretty important source of employees for much of the industry. This should be a market in which things are going well, and on balance, it really is. It's an economy that's in as good a shape as it's been in years. And yet here we have consumer confidence is at the lowest it's been since the 1950s. We have a market that has lost trillion. I think I was looking at it today. The S&P 500 has lost $11 trillion in market value this year now. And, everybody is afraid of what's going to happen, obviously, because all of these things just went into effect. And so we don't know what's going to happen. And I think operators, what do you do in a scenario like this, right? If you're a restaurant operator and you had hoped for something better. And so, after a couple of pretty tough few years, and the only thing I think they can do is just sort of tighten the belts and start and figure out how to work with it, because there's nothing else they can do. Well, I think that was kind of a microcosm. That's a really good observation, Lisa.
Yeah, well, the word of the entire event was uncertainty. So that there's just a feeling of we don't know what's coming. I do think that, and basically people were feeling that whatever's coming, it can involve menu price increases, at least not for, limited service or anybody who's dealing with the lower income consumer. The higher income, I heard several people talking about how higher income consumers are still going out to restaurants, they're still buying. And I'd hate to think that people were going to be leaning into that as their, to really kind of service that market, which always is disappointing. It isn't really possible for everybody to access that market. But, what I think we're going to see is more innovation as opposed to, price hikes, because it's just as we've seen from the top 500 numbers, last year, which was a year of menu price increases, didn't go so well. for the restaurant industry overall. It was up 3%, which was the lowest rate in a decade, right? And except for the pandemic year. And so, I think people are really hesitant to turn to the consumer and say they need to pay more. And we've been talking to everybody about tariffs and how this is going to impact them. And a lot of them, and we're like this morning, I talked to somebody who was saying that they were really going to be turning to landlords to really lean on them to provide more, to pay more in terms of their investments so that they can grow. The landlords need restaurants and they're going to need to, perhaps do more. It's going to end up raising rents, of course, but it's just going to trickle through the whole industry in so many different ways. It's going to be interesting to see.
Yeah. Yeah. Call me skeptical on the landlord thing, by the way.
Yeah. Well, I mean, yeah.
I'm skeptical on everything though, but I mean, yeah. And one note about tariffs. I mean, we did talk to a lot of people, and generally the conclusion is, yeah, tariffs going to happen. It's going to be a bigger problem for development. Packaging actually also a problem, but packaging costs are going to be problematic, and so they're going to have to. So you probably have issues there. But packaging is something that you could probably change. You could probably change your packaging and source something in the U.S., but you're going to have a hard time with some things. And then development costs can be really problematic. But for the most part, what I heard from operators, and I talked to a few of them, was that they're more concerned about the consumer. The consumer sort of drives everything. And like you can, it's one thing, like if you can't source packaging or you can't, that's one thing. You can probably find other sources for some things, and you could take things off the menu. You can raise prices, you can do things. And I think the restaurant industry is actually much better at the supply chain today than they were in 2019 by a long shot. But like, if you can't, if people aren't spending, you need to have customers to justify buying supplies in the first place, Lisa.
Right. Well, the other thing is tourism, which is, actually somebody made that point during RLC, saying that this is an opportunity because consumers are probably going to be traveling less, that gives restaurants an opportunity to kind of create a travel-like experience, that they might spend their money more going out to a restaurant as opposed to if they're not, spending money on that trip, which is an interesting thought. But I'm hearing more from restaurant operators that target tourism areas that are saying, where is everybody? And yes, it's not the best time of year to be traveling to the US, except for hotter, sunnier places like Miami, but it'll be interesting to see what happens with that this year.
Yeah, tourism is going to be a problem, especially places like Orlando, I think. Disney gets a lot of people from Europe and stuff like that. There are going to be a lot of effects that we don't know about. I mean, there'll be some positive effects, for instance. I mean, I think that tariffs are going to be more problematic for the grocer than they will be for restaurants, for instance. And that could provide a little bit of a boost for restaurants, maybe. But that's down the line because those prices take effect. But yeah, there's just a lot we don't know. And we don't know what the tariffs are going to look like. We don't know what's going to happen Monday. I was talking to somebody today who is a consultant with operators in Europe. And we never talked about the tariffs. And one of my concerns actually is like our consumers in other countries going to view U.S. brands outside the United States, for instance, with all of this. Because the U.S. starting it. This is on us. And so what's going to do? I can tell you that every so often, anti-U.S. sentiment in China hits sales. So in those countries. So what happens then? But we don't know what's going to happen on Monday, let alone in a few months. So more to come on that, Lisa.
Indeed. So Jonathan, tell us about this Burger King bankruptcy.
Oh, there's a Burger King bankruptcy? Yes, there was. Yes, a 57-unit Burger King franchisee, Consolidated Burger Concepts, filed for bankruptcy earlier this week. Now, that is, I think, the fifth major bankruptcy of a Burger King franchisee since 2023. And of any of the big major brands, they've had more major bankruptcies, than anything else. Not the biggest. The biggest still is MPC International from Pizza Hut. But so you've got this really large 57-unit Burger King franchisee that operates restaurants in Florida and Georgia and they had every single problem that you would expect a major restaurant operating company to have. They had too much debt, Lisa, and debt is a major cause of bankruptcies, as you might imagine. Burger King's sales have generally been weak over the past few years, and Burger King generally makes lower unit volumes than its competitors. A typical Burger King does about $1.6 million per store, compared with $2.1 million at Wendy's and nearly $4 million at McDonald's. And they're very similar models. So your average Burger King franchisee generates a lower profit. And so when you have weak sales and you have companies with a lot of debt, that's bad and it results in bankruptcies. But there was another thing, Lisa, on this one. And the franchisee had just settled a lawsuit filed by Burger King corporate over remodels. They had not kept up with remodel requirements. Most franchisees have to remodel every few years according to their franchise agreement, and it's really important in the QSR space because people like going to fresher, newer restaurants. So just a difficult situation, as most of these are. The company is looking to reduce debt and find a buyer, but they haven't been able to find a buyer as of yet because people are investors are a lot less likely today to invest in restaurants, period. And especially restaurant companies, restaurants and brands that have low unit economics. It's just really, really, really difficult. You can't get them financed. People don't really want them. So any buyer is going to want those restaurants at a steep discount. So that's what's happened. And it's just another one. We've had a few of these.
Well, so this is within the context of our top 500 had Burger King basically flat, for system wide in the US. Is this a Burger King issue or is it just this operator, do you think?
It's a bit of both. All bankruptcies, there's rarely one single factor that causes a large company to file for bankruptcy. There's usually a multitude of things. And on balance, you have to have a structure that you usually in these cases they have a lot of leverage in one form or another. So you usually have you've taken on secured debt, bank lending, and then you have a lot of leases. And a lot of these companies have long ago eschewed the whole idea of owning real estate because, private equity firms and a number of franchisees and a number of companies have said, we don't want to deal with the capital costs, and they either sell their real estate or they don't deal with it from the get-go. They have somebody else own their property, for better or worse. I'm not a huge fan of that. And then Burger King, they've had weak unit volumes. They've traditionally had substandard real estate, substandard locations than your McDonald's in particular. And the brand it's just for a long, long time, except for a few years between the years I think of 2012 and 2013 or so and about 2019. But for years, they've just really had a tough time really gaining any real traction for any length of time. And it's really hurt their volumes. I mean, you're a Burger King operator. They're doing breakfast, lunch, and dinner and late night, and then you're making less than half of the volumes of the market leader. That's tough.
Well, we've talked a lot about chicken, the rise of chicken over the years here, but it's what's interesting in the top 500 is what's going on with burgers. And there's just seems to be a real, there's some real winners and losers. I feel like these numbers show this year.
Yeah. I mean, that is very true. The burger sector is fascinating, Lisa. It really is. And I think that I have a tough time trying to figure out whether it's just the brands and a shift in consumer sentiment from certain brands to other brands, or it's just the base of customers that each of these brands have, and probably a bit of both. But if you look at concepts that you think are traditional fast food burger chains: McDonald's, Wendy's, Burger King. I mean, I'm going to lump Sonic in there. Sonic is a very different type of concept, though. It's not really traditional. So they're a little bit of the exception, and they've had a tough time the past couple of years. Jack in the Box, Hardee's, Carl's, White Castle, and then we'll also lump Steak and Shake in there. But again, Steak and Shake's a bit more like, well, I don't even know what to even classify Steak and Shake anymore. And all of those brands had generated sales growth well below that of menu price inflation, which means they lost customers last year.
Right. Yeah. 5% declines. Yeah. Five Guys, Farmer Brothers, Smash Burger.
Five Guys is a different thing, I think. And I think the one of the problems with Five Guys in particular, actually Five Guys and McDonald's have very similar issues from last year. Social media ripped the hell out of them. Five Guys for their, they were hammered, and they're expensive. You go to Five Guys, you're spending a lot of money, and social media wasn't kind to it. They just weren't. It wasn't. Last year, social media is very interesting. It is and we don't. Social media was exceptionally kind, for instance, to Chili's last year. Chili's, a big reason why Chili's did so well last year was social media was exceptionally friendly to it. I mean, the thing that we talked about with Chili's is that they were ready for that, right? And so their operations are really good, so they didn't die off. But social media has hammered, and I still don't think operators and executives fully appreciate just how influential social media is in this day and age to a lot of companies. Five Guys was hammered for their prices, and I think that's why Five Guys sales declined last year. Total sales declined last year. Yeah. It's why it is the same reason why McDonald's had problems. McDonald's was having a problem because of media issues, and people were paying a lot of attention to McDonald's prices. Again, consumers are frustrated over high prices. Absolutely. And then social media fueled that. Social media was also unfriendly, by the way, to Starbucks.
Starbucks. I was just going to say, Starbucks. Yeah, for sure.
Right.
But then look at some of the people, the chains that are winners this year. And you can, again, go to social media marketing and how they did it. Raising Cane's is now in the top 20, and they are brilliant on every platform. I mean, the marketing that they do is really amazing. And I have to say, Chili's should be given credit for that as well. As you said, Chili's was ready to have, operationally, to have the kind of crush of people that they did. But some of these people, and Chipotle, who was also skewered on social media last year, remember the whole portion size thing? They really turned that around. So you got to give them credit for the fact that they kind of came back and said, we're going to do better. And they did. People kind of forgot about it. They love Chipotle again. Yeah. And they had a good year.
Yeah. Chipotle is interesting. They're actually kind of almost an exception, right? Because I expected the same thing to happen to them, because everybody was forwarding me some Chipotle portion size thing. Part of me thinks that, and I think it was the Wall Street Journal that wrote about this. You get so many calories for what you're spending at Chipotle. That's really hard for certain people to break away from it, because the thing about Chipotle, and one of the secrets to their success that nobody really talks about that much, is that you get a lot of calories, Lisa. But
it's protein. It's protein that they're looking for.
It's protein. It's infinitely flexible. The menu is beautiful. The menu at Chipotle is arguably the single best menu in the restaurant industry today. I would guess, because it is super, super flexible. Wide range of people like it. But yeah, I mean, there's protein. You've got beans, rice. You can have vegetables. You don't have to have meat in it, and you can still get a lot of protein because you got to have beans in it. You can if you want to put a bunch of calories in it, you could put it all in a burrito, and then you're getting more calories in that Chipotle burrito than you would get if you had a Big Mac, large fries, and a Coke. Not a Diet Coke, Lisa. A Coke into that burrito if you put avocado and stuff like that. It's amazing. Yeah, it's not whatever. Sour cream. Yeah. So you're getting a ton of calories for that. And that's the one exception on the social media thing. But yeah, social media really hammered companies like that.
Yeah. And then, another winner would be Dave's Hot Chicken, which was won the Pacesetter Award at RLC this year, and rapidly growing chain. And they're also just, totally they know how to work social media, these people. I mean, so that's a huge strength for them.
Yeah. Yeah.
So, I mean, we're going to see brands like Whataburger, for example, I think is another one that I'm starting to notice is really playing the social media game really well.
Yeah. You
Brand
have
that's
to do
growing.
it. You have to. You have to.
Yeah.
If you're a major brand in the United States, if you're a brand that has designs on being a major brand, doesn't matter who you are, you have to have a team, a team of a couple of people that their focusing is on social media. I have an upcoming episode of my podcast, A Deeper Dive with George Felix. We talked extensively about social media on that. It's fascinating. He's smart, by the way. He's a future CEO. I don't think there's any question about it. You heard it here, probably third, I guess. But and I think their social media team was combing combing social, saw the consumer frustration about prices, and they just started hitting it. And sometimes it's about noticing what is happening and then trying to take advantage of it. Now, they didn't see necessarily the cheese pulls kind of surprised them, but and they again took advantage of it. But it was some of the pricing stuff that they did last year and the competing with McDonald's and things that was really brilliant. So you have to focus on social media. It is not, it really is super, super important. And it can be, and sometimes it's about combing social media for what they're saying about you that you don't like. That's actually probably more important, so you could figure out a way to head it off.
Right. It's social media. For me, it feels like trying to train a tiger. I mean, it's like something that can just turn around and bite you at any minute. It's so hard to control how people react to your brand. But it is interesting to see how people are kind of very strategically, I think, figuring out how to navigate it all, and make it work for them, kind of channel the tide.
Yeah. All right. Awesome. Well, coming up next, we will have Joe Guszkowski coming on to talk about both Hooters and his thoughts on technology at the Restaurant Leadership Conference. But first, whatever ad our esteemed podcast editor Spoons puts up next.
Our industry is grappling with uncertainty. At the 2025 National Restaurant Association Show, you'll explore innovative solutions, strategies, and partnerships that will prepare you for whatever comes your way. Take it from me, the show has everything you need to elevate your front and back of house. You'll see, touch, taste, and demo the latest trending products across more than 900 categories, including food, beverage, technology, equipment, and more. Don't miss the industry's most trusted event taking place in Chicago, May 17th to 20th. Secure a badge by May 9th to save $30. Register today at nationalrestaurantshow.com. Rate quoted ends on May 9th and applies to operators only. Non-exhibiting suppliers are subject to a higher badge rate. Please check out the show's website.
Hello and welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, I've just returned from the Restaurant Leadership Conference in Phoenix, and the talk of the event as far as tech goes was personalization. That's right, personalization came up again and again during the 3-day event, and far more than it has in past years. It continues the trend of restaurants going digital and shows that they're now looking to tailor those digital experiences to individual customers. So why is personalization good? Well, research suggests that it's what consumers want these days. According to a 2021 McKinsey study, consumers view personalization as the default when they're engaging with brands, and they're more likely to buy from those that do it. Restaurants have some catching up to do in this sense, because personalization requires data and the expertise to analyze that data and generate the personalized outreach. Restaurants are still in the early stages of becoming more data-driven, but it's clearly where the industry believes it has to go to drive growth and keep customers coming back.
We're here with Joe Guszkowski. Joe, I hear you've done a story on Hooters. Tell us about it.
That's right. Well, obviously, Hooters, filed for bankruptcy last month.
I hadn't heard that.
Yeah, so that's good to know going into the story. So I started looking into that, of course, talking to a couple of former employees and also the CEO of the company that is going to be taking over some of those bankrupt restaurants, and kind of created a picture of what happened there. And as with most bankruptcies, it's a combination of things. Very, very difficult time for casual dining with the way inflation has gone. they had to raise their prices, and they had a lot of debt that was taken on by their owners, private equity owners, and they ultimately were unable to keep up with those payments and went into bankruptcy. The interesting thing about this story was, well, first of all, Hooters has a very unusual history, and so I got to write all about that. I pretty much start at the beginning and take you all the way through the bankruptcy up till today. And it's sort of a full circle situation, because the original founders of the chain will be sort of rescuing a lot of those bankrupt stores and trying to turn them around. And there's sort of two branches of Hooters: the branch that filed for bankruptcy and the branch that is swooping in to take over. And they've diverged over the years on things like the uniforms that the waitresses wear, the ingredients that go in the sauce. And so, the arc of the story is that Hooters is coming back home in a way, and we'll see if they can return it to its former glory.
All right. Fantastic. Absolutely one of the most interesting situations that we've seen in the restaurant industry for over the past couple of years. So check that out on restaurantbusinessonline.com. And that will do it for the week in restaurants. Much thanks to Lisa and Joel for once again joining us. This podcast, as always, was edited by Spoons, artwork by Nico Hines. You may find this and other podcasts on our website at restaurantbusinessonline.com, but please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, the editor-in-chief of Restaurant Business. Thank you for listening.